Good afternoon, everyone. I'm Patrick Gaspard, the President and CEO of the Center for American Progress. Welcome to today's event. And what an event we have in store. I'm thrilled to be joined today by an all-star panel of three eminent economists whose impacts stretch across public and private sector policymaking. Their research and analysis has been core to economic deliberation at the highest levels of government throughout the last 20 years, last 30 years, actually. I'll bring them into conversation in just a moment, but first, let me say a few words to table set our discussion. Last week, the impasse broke. After months and months of negotiation, Senator Manchin and Leader Schumer announced a historic agreement in the form of the Inflation Reduction Act. This bill tackles the greatest challenges of the day by battling the climate crisis, reducing the cost of medicines and energy, increasing access to healthcare, and making corporations pay more of their fair share. It's a powerful signal to the American people and to our international partners that the US can take on these crises. But crucially, this bill does more than that. All told, the bill is designed to invest in the economy and move inflation in the right direction. At a time when the rising costs of food and gas, of goods and services are putting strains on American households, the president and Democrats in Congress are proving that they're willing to do everything in their power to deliver for average Americans. By closing tax loopholes on the wealthiest of corporations and individuals, as well as investing in domestic manufacturing and clean energy, this bill is designed to dampen demand and increase supply. And with key provisions to cap out-of-pocket costs for Medicare beneficiaries at $2,000 per year, as well as energy rebates and consumer tax credits for energy-efficient homes and vehicles, this bill is custom built to push down key costs for consumers. At the same time, the bill will reduce the deficit by a projected more than $300 billion over the next decade, on top of $1.7 trillion in projected decreases this year, which should put less pressure on the Federal Reserve to raise interest rates, helping to avoid a potential recession. I know our economists will have more than a few things to say about that. This bill is also set to supplement the economic benefits of the recently passed CHIPS and Science Act, a bill designed to boost semiconductor manufacturing, shore up supply chains, and lower the cost of cars, appliances, and more. The benefits of these investments in a strong, clean energy sector will lead to better jobs, lower prices, and lower pollution amid the fight to tackle climate change. So all in all, the provisions outlined in the Inflation Reduction Act and in tandem with CHIPS and the Science Act go after the structures that keep costs high and leave us vulnerable to supply shocks. With all of this in mind, I'm delighted to welcome Dr. Blinder, Dr. Clausing, Dr. Zandi to hear more about how they see this bill strengthening the economy as we go forward. Dr. Blinder is, of course, the Gordon Rentschler Memorial Professor of Economics and Public Affairs at Princeton University. He served in President Clinton's administration, first as a member of the Council of Economic Advisors, and then as Vice Chairman of the Board of Governors for the Federal Reserve System. His work has focused on a number of areas, including central banking, monetary policy, including the topic of inflation. And I don't hesitate to say that for those of us who work in public policy, he is nothing short of a legend. Dr. Kim Clausing is the Eric M. Zolt Chair in Tax Law and Policy at UCLA Law School. Over the past year, she served as the Deputy Assistant Secretary for Tax Analysis in the U.S. Department of the Treasury for President Biden and was the lead economist in the Office of Tax Policy. She also worked as a non-resident senior fellow at the Center for American Progress for a number of years. And so it's wonderful to welcome Dr. Clausing back to CAP. And Dr. Mark Zandi is the chief economist of Moody's Analytics, where he directs economic research. He's on the board of directors at MGIC, the nation's largest private mortgage insurance company, and is the lead director of Reinvestment Fund, one of the nation's largest community development financial institutions. I don't think that there's anyone who is more quoted on economic issues than Mark Zandi is. There's an old joke that if you pull three economists together, you're likely to have 30 different opinions, but I'm impressed to see the near consensus that we have from these luminaries on the impact of this bill and the state of play in our economy. So we're going to jump around a little bit and try to touch on everything that's in the bill, but I think it's really quite important for us to get on the same page on the landscape.
Looks like we lost him. I don't know if another cat person wants to jump in while we're waiting.
I'll jump in if folks can hear me. My name is Lily Roberts. I'm the managing director of the Poverty to Prosperity team at CAP. And while we're getting Patrick back, I will toss the first question over to Dr. Zandi. Patrick was going to ask us to sort of frame out the conversation to begin with, to give us a little bit of context. We've faced some really unusual economic headwinds over the past few months. There's been an incredible labor market recovery since 2020. The economic policy that we put in place in 2020 and 2021 supported people through the uncertainty of the pandemic. And then we've also seen inflation exacerbated by world events like the war in Ukraine. Dr. Zandi, wondering if you could start us off today by sort of orienting us to where things stand now, and how the Inflation Reduction Act could, as you've said, nudge the economy and inflation in the right direction.
Sure. Well, thank you, Lily, and I want to thank CAP for the opportunity and to be on this conversation and to be on with everyone. So I appreciate that. I think it's fair to say the economy is struggling. That growth is slowing. We saw that with 2 consecutive quarters of negative GDP. Jobs are stronger, but job growth is going to slow here as well. We'll get another read on that tomorrow with the July employment numbers. Inflation is high, painfully high. CPI inflation, consumer price inflation, is just over 9%. Just to put that in concrete terms, the typical American household who makes roughly $65,000 a year needs to spend just about $500 more a month. And I'm rounding, obviously, but very, very close to $500 more a month to buy the same goods and services that they were buying this time last year. So you can kind of do the arithmetic. That's very painful. And of course, the Federal Reserve is working now very hard to slow growth, so slow employment growth, so that the economy doesn't go past full employment and exacerbate wage and price pressures, and keep inflation expectations tethered, because that's really key to where inflation is headed. And in that environment, with high inflation and higher, quickly rising interest rates, it puts a lot of pressure on the economy. So the economy is weak. I will say, it's almost a miracle that the economy is doing as well as it is, given the massive shocks it is trying to work through, the supply side shocks, the pandemic, which continues to create havoc in supply chains. I mean, you can see what's going on in China that reverberates back on us, and in labor markets. We're going to see that maybe tomorrow with the number of people that just couldn't go to work because of the increase in COVID cases. So that's still doing a lot of damage. And of course, the Russian invasion of Ukraine, massive supply side shock that was not even on the radar screen this time last year, sent oil prices skyward, natural gas prices, agricultural prices, which obviously is feeding into the inflation that we're suffering right now, metals prices. And I do think it's been the very supportive fiscal and monetary policies up to this point that have helped the economy kind of navigate through. Now, this goes to the Inflation Reduction Act. In my view, there's a lot to like in this legislation, that it nudges the economy in the near term in the right direction. It's not a game changer in terms of inflation, at least in a macroeconomic sense. I mean, it is important for certain groups in terms of their inflation rate and their cost of living. So if you're a senior and you buy prescription drugs, this is a big deal. If you're a low-income household that receives health insurance through the Affordable Care Act, this is a big deal. And then ultimately, it's going to be longer run a big deal for all of us, because in my mind, the most significant aspect of the legislation is the provisions around climate change. And those play out over a long period of time. They're not going to move the dial next year, the year after, even in a decade. But you do the arithmetic here, This is a very significant piece of legislation that will ultimately reduce energy costs for everybody. So, I do think that it's a very, very important piece of legislation. Last thing I'll say, that's also, I think, important and not well recognized. This legislation is more than paid for. It reduces budget deficits over the next 10 years. It's $300 billion. But you do a little bit of arithmetic looking out into the future in the next 10 years. With these tax increases, which are here to stay on large corporations and on the wealthy, and the one-time spending and tax credits related to the climate change and the other elements of the legislation expire over the next 10 years, we could see deficit reduction that's closing in on $2 trillion. So that's not inconsequential. And in my view, at this point in time, important policy. So you add it all up, if I were king for the day and I was focused on inflation, I might have come up with a different piece of legislation, but I'd need to be king and I wouldn't have to have any political constraints. And I need more than a day, maybe I need a week, but I'd come up with something different. But given all the constraints here, I think this was a very laudable effort.
Well, Mark, you can be king at least for the hour of this phone call. And I'm going to go to Alan to follow up on much of what you just said about the state of the economy, and then ask him some very specific questions about the legislation. But I'm going to sit with you for a second, Mark, because you said, I want to be really clear. You said that this is not a game changer. I want to be clear that you're talking about inflation, because inflation in the near term, because this is a game changer on climate, certainly a game changer on prescription drug benefits. We've been clamoring for this kind of reform for so very long, and it's just tremendous to get it now, which is one of the reasons why we think this will be transformational in the lives of average folks, for seniors who are struggling on fixed incomes. So I just want to be certain to have clarification on those game-changing aspects. And then I'm going to ask you one more thing. As you talk about the weaknesses in the economy, I wonder if you might say something about what we saw in the latest GDP report on the continued shift from goods to services and consumption, and how that might be a good sign.
Yeah, and you're absolutely right. And let me be very clear. When I meant game changing on near-term inflation, what's going to happen here over the next quarter, next year or so. And, that's not surprising, right? I mean, fiscal policy, and that's what we're talking about here, fiscal policy has very limited tools that it can use to address inflation, certainly in the immediate future. That even if you were king and you could do exactly what you wanted to do, that's a pretty long bridge to get over. So this is why monetary policy, this is the purview of monetary policy. But even that in the current context, it's rather limiting, right? Because the inflation is due to the Russian invasion of Ukraine and the spike in commodity prices. It's due to the pandemic and the impact on supply chains and labor markets. These are supply side problems that can't easily be solved certainly not by fiscal policy, and even by monetary policy. It's going to be very difficult, for them to do that. On your question about the shift in consumer spending, that is happening, and you can see, just the level set for everyone, during the teeth of the pandemic. If you go back, when we were all sheltering in place, we couldn't travel, we couldn't go to ball games. I know Alan loves Yankee games. He couldn't go see his Yankees. Which we try not to hold that against them. That's exactly what I said to him, Patrick. Yeah, I won't hold him against. I'm a Phillies fan. I'm from Philly. And we were buying stuff, right? Because we were on our, in our homes and buying things. Now that the economy is reopened, we're out and about, we're traveling again. And I don't know if you've been traveling at all, but people are traveling. There's a lot of traveling going on. The spending is shifting. And also we've already bought all kinds of stuff. Like I bought, believe it or not, I don't know why, 2 power washers when I was stuck at home. my wife goes, "Why are you buying a second power washer?" And I said, "Because I need one to wash the other one." So that's how crazy things were.
That's
Yeah.
illustrative of how the consuming patterns that we had during quarantine, and we're decidedly seeing a shift.
Yeah, that's called spent up demand, and we're spent up, and now we're doing these other things. So we're seeing this shift, and in that transition, I will say that's also contributing to the weakness in the economy because it's not a perfect baton handoff in a 440 relay. You know, there's a little bit of transition issue here, so it's taking a little bit of energy out of the economy as that transition occurs.
Thank you so much for the clarifications, Mark. So over to Dr. Blinder. There's no way that I can just get into the question with you, Dr. Blinder, about the impressive suite of interventions that we have here, from IRA to the CHIPS bill to the bipartisan infrastructure bill. I absolutely want to get your perspective on how you're thinking about this suite of policies working together to strengthen the economy. But I think it's necessary to begin with you on your assessment of the relative strengths and weaknesses of the economy. There's been so much in the media about how one defines a recession these days. I heard you call it, a close call, like a bang bang play at first base. But I hope you'd give us your sense. And I ask you this question, Dr. Blinder, appreciating that all of us break out in hides when we're asked to forecast the future beyond 3 months, and we're suspicious of anyone who tries to do it beyond 6 months.
Yeah, you should be suspicious and break out in hides, because our ability to forecast, as is illustrated by the recent past, what's going to happen in the next 6 months is pretty limited. The way things look right now is that I think nobody really can tell whether this will, in retrospect, be declared a recession, where we are right now. And that's because it depends on what follows. We've had these 2 negative quarters of GDP growth, GDP decline that Mark mentioned. Each one looked flukish for different reasons. In the first quarter, it was that imports just surged. I think it was a 19% annualized growth rate in that quarter. That's wild. Imports come in negatively to GDP. So if that didn't happen, we wouldn't have had a negative quarter. In the second quarter, we had a huge disgorgement of inventories. Firms in the first quarter stocked in too much in inventory. You're hearing about this with Walmart and other companies, but it's in the macro data. That in itself knocked 2 percentage points off the GDP growth rate in the second quarter. So again, if that didn't happen, we wouldn't have had a negative. What's going to determine this is what happens in the next few quarters. If we go downhill, and we might, into what looks more like a recession than what we have now, the National Bureau of Economic Research, which is the official arbiter of these things, will do what they do. They'll look back in history and say, oh, we have a recession here. When do we think it started? And they'll probably date it starting in the first quarter. But if that doesn't happen, if we somehow muddle through with positive, though not robust growth in the next few quarters, which would be my guess, but I want to emphasize guess, then I don't think they'll look back and say a recession started in the first quarter. They'll look at those 2 flukish quarters and say, well, those were flukes. Flukes happen. You can look at the history of GDP in non-recession periods, and you find negative quarters scattered here and there. Yes. It happens.
Yeah. Or points of weak growth during periods that retroactively were considered recessions. So
yeah, they look back later.
Yeah. So now, given that take in your assessment, I'd ask you to pivot to help us all appreciate why those of us who care about the strength of the economy should be thinking about these suite of policies, how they work together to bring core strength to American households.
So it occurred to me, when you think about the IRA, which we all hope will pass very, very soon. I think it will. I hope it will. It's a very good bill. And the CHIPS Act that just passed, and then go back to last year's bipartisan infrastructure bill, another minor political miracle. You put all that together, and what you have is a serious program of real supply-side economics. And I want to distinguish that from cutting the income taxes of the richest Americans, which is what supply-side economics has come to mean for many Republicans going back to Ronald Reagan. Most of us economists have poo-pooed the positive supply effects of those kinds of policies. Charlie Schultz, who I remember fondly, quipped way, way back that there's nothing wrong with supply-side economics that division by 10 couldn't cure. So they had the direction right, but grotesquely overestimated what you should affect. And that's on a priori basis, based on evidence. And then you could just look at the data. We did not get accelerations of economic growth after the Reagan tax cuts, after the Bush tax cuts, after the Trump tax cuts. I don't know how many times you have to repeat this play. We know the ending, but one side won't agree. But if you build more infrastructure, if you build up a manufacturing base, if you put in place some of the climate change initiatives that have been long, long overdue. I mean, we should have done this 15 years ago. But for, whatever reasons, Patrick, you can figure it out. This became a terribly politicized issue. My goodness, burning up the planet? Should we have two sides on that? I mean, who's in favor of frying the planet? But it has become, and it's been very difficult. And it would just be great to get this. I consider it a down payment. We're going to have to do a lot more on climate change, but it's a non-trivial down payment and a very important down payment in an area where, as I just said, bipartisan agreement has been hard to come by. Well, we don't have it now. The Republicans are not going to vote for this. But I hope that we will get it. So you put all that together, and I think you have a serious supply side program. So supply side means expanding the economy's ability to produce. And that's what this is about.
And it also leads to greater and greater inclusion and a broadly shared prosperity. So thank you so very much for that assessment. I'm going to come back to you, Dr. Blinder, when we get a little further into the conversation, so you can help us all understand what it means to have softish, and hard landings when we talk about the tools that are available to the Fed. Dr. Clausing, we're coming to you, and I'm hoping that as I come to you, we're going to rally a little bit of enthusiasm here for the bill. Mark described it as a lot to like. Alan said it's a very good bill. So that I'm hoping that we're going to be ratcheting up the rhetoric here on what the Investment Recovery Act means as we get to your box.
I'll say it's an excellent bill.
There it is. We're building momentum here. We're building momentum. That's advocacy. So I'd like to start with you, if I could, Kim, just to dive into the ways that taxes connect directly and indirectly to inflation. But I'm hoping you can start by giving us your sense of why those who care about building a strong economy, a strong middle class, should be so invested in the design and enforcement of our tax code. And you can trust that I'm going to have a follow-up question to you about that Wall Street Journal editorial.
Okay, well, I agree with Alan that this is an excellent bill, and just to focus on the fundamental reasons why, these investments in climate change, these investments in making healthcare more affordable, these investments in building a tax system that's fit for the modern economy by adequately funding the IRS, these are just enormous achievements. So to take the inflation side, as Dr. Zandi noted, inflation is unacceptably high. That's widely recognized by both right and left. Congress has a pattern, which you will note, of passing legislation that tends to make the deficit worse rather than better. It's a lot easier to make the deficit worse rather than better because, you can spend on things and people like that. You can cut taxes, people like that. Raising taxes and reducing the deficit is much more difficult to do. And so another thing to really like about this bill is that Congress has shown a lot of courage in fully funding all of the priorities that we just described, and then some, right? Build some deficit reduction in. And that's important, not so much in that it's going to, completely wipe out inflation. It's not, but the sign is in the right direction. We're helping make it a little bit easier for the Fed. And we really do think it's the central bank's job to manage inflation, but we're making it a little bit easier for them instead of making it a little bit harder. And that's a really important factor to bear in mind in thinking about what to like about this bill. As I believe Dr. Zandi also pointed out, that for some people, or this could have been Dr. Blinder, I'm not sure. For some people, this will have a big impact on their personal consumer price index, right? If you're a senior citizen buying medication, if you're a person who relies on subsidies to purchase your health insurance, both of those goods will be less expensive because of the bill. And there are other micro things that will kick in down the road too. If you're, for instance, concerned about the climate, not only are you addressing the climate with these green energy tax subsidies, but you're also bringing down the cost of electricity through multiple mechanisms. So that's all really good. On the tax side, there's also a lot to like here. I mean, the taxes have multiple roles in our economy. One is to provide revenue, right? To fund the state, to fund civilization, to do this deficit reduction, you need revenue. But fairness is another issue that is really important with the tax code. And this legislation makes the tax code fairer in two really important and salient ways. One is by asking corporations that have been reporting to their shareholders that they earn over $1 billion in financial profit to ask them to pay at least 15%, which, to put it in perspective, when a worker works their first hour, right, the payroll tax will take 15%, whether remitted through the employer or the employee. So we're just really asking corporations to contribute a similar amount if they're highly profitable, very large corporations. And I think that meets most people's definition of fairness. Also, it's fair in the sense that the tax system itself has ceased to function as well as it should because of persistent, long-standing underfunding of the IRS. And when you deplete the IRS of resources for a long time, they can't audit millionaires, they can't enforce the tax code on businesses, they can't make sure that people aren't just misrepresenting their economic well-being. And this has particularly helped tax cheats and tax cheats at the top of the income distribution. So being able to give people faith that when they pay their taxes honestly, that other people are also being asked to pay their taxes honestly, will also be another point in the fairness category for this legislation.
So let's stay on taxes for a bit longer, if we could. So as the non-economist here, I'm kind of really befuddled by some of the comments that one hears from politicians who are saying things like the corporate minimum tax is going to be inflationary. Taxes on the wealthiest individuals will be inflationary. That just seems incongruent, and I hope that as an economist, you can unpack that for us all and bring us back into a grounded perspective. And then, if you could, while I have you, I want to take advantage and ask you to say a thing or two about the recent Wall Street Journal editorial that suggested that all of this was going to be a resounding tax on the middle class.
Yeah, so let's take those one at a time. So economics textbooks for many decades, including one that Dr. Blinder helped write, have made it quite clear that when you increase taxes, ceteris paribus, holding constant other things, right, that reduces the aggregate demand in the economy. And if you look at our inflation problem that was, very coherently described earlier as being a mismatch between supply and demand, we've had some supply shocks that have reduced supply, but we have robust demand because many features of the economy are actually doing pretty well. So when you compare that mismatch, the demand is exceeding supply. that generates inflation. There's a couple ways to bring that down. One is to rely on the Fed to raise interest rates, which will reduce aggregate demand through a number of conventional channels, reducing investment, debt financed consumption, or net exports through dollar appreciation. But on the fiscal policy side, what can Congress do, right? Well, they can reduce the deficit. And if you increase taxes holding spending constant, or if you just increase taxes more than you're increasing spending, that's going to reduce the deficit. And when you reduce the deficit, you're pulling aggregate demand out of the economy, right? So that the sign of that influence is very clear. And completely uncontested in the economics profession. Even conventional economists who might support tax cuts for other reasons would realize that if you cut taxes, it stimulates aggregate demand on net. That's just a very conventional view. Turning to this question of how these tax increases affect the middle class, these tax increases are completely consistent with the president's pledge not to have any tax increases that would show up when people are paying their taxes at the end of the year, right? So you could imagine what your employer withholds from your paycheck, what your reconciliation on April 15th, none of those will be changed whatsoever if you're an individual earning less than $400,000. And that's absolutely crystal clear here. There are some indirect effects that the Wall Street Journal and others have worried about, which is this idea that, well, maybe somehow corporations can shift some of this burden of the corporate tax onto their workers, or maybe their workers might own some stock and that might affect them through that mechanism. I think we've seen a lot of evidence that coming out of the Tax Cuts and Jobs Act, that despite huge corporate tax cuts, we did not see unusual wage growth. Wage growth just looks like this very normal trend line. If you showed an economist living on another planet the wage growth path and asked, like, where is the tax bill that might have affected that, they wouldn't be able to pin out where the tax bill was in the time series. And that's not just true for the United States, it's true for Japan, it's true for Germany, it's true for the UK. If you look at countries who have run this experiment of dramatically lowering their corporate taxes and hoping that that led to wage growth, you just don't see evidence with big countries like ourselves. And I think part of the reason that is because the corporate tax base is really mostly a tax on excess profits, on profits above the normal return. And when you tax profit, right, the same economic decisions that made the pre-tax profit as high as possible will make the post-tax profit as high as possible. So it's actually a pretty non-distortionary tax from an economist's perspective, because companies shouldn't change the amount of capital they're using or the amount of labor they're using, because the decisions they were already making maximize that profit. And the government is simply sharing in that a little bit more. And I think that's one of the major reasons you don't see these big wage effects, and why workers can rest assured that this very modest corporate tax increase isn't going to come out of their paychecks.
Critical and accessible delineation of what all this means. Thank you so much. I'm going to
Could I just add one little footnote to that?
You can, but I'm going to ask this, if you could, Dr. Binder, because I am coming to you next. So you can have the footnote, but then I'm hoping that you're going to take off from the footnote and begin to walk us through your sense of the Fed's approach on reducing inflation, and what other tools we have in the toolbox that could supplement or substitute for rate hikes, and what the timeline is that you believe is for how long it'll take for us to begin to expect to see some benefit and some impact. But you can start with your amendment.
The footnote is short about the corporate income tax. There was a big to-do about the corporate income tax early in the Trump administration. And the claim was that we way overtaxed corporations. That was not true. What was true then is that we had a very high, by world standards, statutory corporate rate, which was legally evaded because of a proliferation of tax loopholes. So it was a Swiss cheese tax. It looked like something big, but it was full of holes. What did we actually do? And when I say we, not we Democrats, what do we actually do? Slash the rate, but didn't attack the loopholes, and in fact added a few more loopholes. This is exactly the wrong thing to do. Why am I putting this footnote in? That's why the minimum tax proposal is so important. we have had not just the current Congress, but a whole succession of Congresses that won't attack the corporate loopholes. They just leave them or put in more. And one way, so a better way would be to attack the loopholes, take the loopholes out, but they won't do that. So the minimum tax is kind of a crude sledgehammer approach that just limits the use of the loopholes. Doesn't take them out, they're still in the code,
Yes.
but you can only use them to a limited amount. That was my footnote.
That's a great footnote, and makes the cheese a little bit more dense. So
Yeah.
if you could, Doctor, let's pivot to a place you know well, where you served, and we all know the extraordinary responsibility that you had in managing a period of a recession and rapid recovery. Hope that you can just begin to talk about the Fed's approach to inflation reduction and the tools that you believe are available to supplement or substitute rate hikes, and what your sense is for when we might begin to see some of the beneficial impacts.
So let me start by saying, as everybody, including Jay Powell, has said, that the Fed started on this anti-inflation crusade too late. They were behind the curve in the market lingo, and they've said so. Everybody has said so. I think some of that was a little bit of that was an error you could see in real time, but a lot of it came as a surprise because of, as Mark was saying before, the war in Ukraine. Now, there are four basic causes of inflation, and my point is the Fed only has leverage over one of them. This is consistent with what Mark said at the beginning, and I know he agrees with this. The one it has a leverage over is the state of demand. And as Mark said, and as Kim said, when you get demand out, aggregate demand outstripping the growth of aggregate supply, that's inflationary. And the Fed has tools, which I'll come back to in a second, obvious tools, to slow down the growth of aggregate demand, and that's what it's doing. Second source is these supply difficulties stemming from the pandemic. We talked about that already. Third source is energy prices, which were going up during the recovery and then skyrocketed because of the war in Ukraine, and blissfully now are coming down. Knock on wood. We hope it continues. And the fourth is food prices, the similar source, the grain that's not coming out of the Ukraine and Russia and things like that. On those last three, there's nothing the Fed can do, except hope. I'm sure they all got their fingers crossed and their hands in praying position, but that's what they can do. They can pray, same as us. What they can do is raise interest rates to throttle back demand. And that's the basic answer to your question. And they're doing that rapidly. Excuse me, a swallow of water. They're doing that rapidly because they're behind the curve and they're trying to catch up. The other tool they have, which they're also using, is switching from what's called quantitative easing, which is buying assets, adding to their balance sheet, to quantitative tightening, which is selling some of those assets. That will have an effect on interest rates as well, although the interest rate tool itself is far and away the most powerful tool that they have. And that's the one they're going to use mostly, and they're not finished.
I'm going to let Mark come in on the backside of that, if we can, Doctor. So, Mark, you've obviously talked a lot about this last few weeks and days and written about it as well, but would love it if you could add your thoughts here on how we can use fiscal and monetary policy to come down from inflation thoughtfully. And then after that, Mark, I'm going to ask you if you could give us your sense of the economic impact of the investments that are being made in climate. If you could just kind of dig into that, because I think that it really is a huge deal.
Sure.
And want to hear your thoughts on it. And then Kim, when I come to you, giving you a little bit of a heads up, when I come to you, I want to I want to change things up a bit because you served most recently in government as part of this administration. And I'm really intrigued by what Dr. Binder just said now about coming to the rescue too late. And I wonder, as a policymaker advising government leaders now and into the future, what lessons you think we need to take away from that and apply that to implementation. But back over to you, Mark.
Sure. Well, I think Alan did a wonderful job kind of laying out, what the Federal Reserve can do in the context of the situation we're in. On fiscal policy, I'll just I will play king for a minute. And if I had my druthers, I think policymakers, lawmakers should focus on the housing shortage, that we have a very severe affordable housing shortage. It's been building since the financial crisis. And by my calculation, we're short about 1.6 million homes, which is about a year's worth of housing production at the current rate. Vacancy rates are record lows for home ownership and for rent. And we've seen rent growth go skyward. I mean, double-digit rent growth. And that's the single most significant contributor to kind of underlying inflation, CPI inflation. And that's not going to go away. So when the pandemic fades and the supply chains iron out, vehicle prices come in, when energy prices come in as the Russian invasion becomes less of an issue, we're going to still be left with very high rent growth. And, everyone is struggling with this everywhere in the country, coast to coast, every single community. And there are some things we could do here that I think would be very beneficial, particularly on the tax side, because they can work quickly. And I think you could get bipartisan support. I go to LIHTC, low-income housing tax credits, tried and true. New market tax. As you pointed out, I'm the lead director of a CDFI. We use new market tax credits to build affordable housing. Neighborhood tax credit. This is a new tax credit that would be helpful in inner cities to renovate property. So if I were going to, and this isn't going to change the dial on inflation this year, but these are things that could change the inflation dial next year and the year after. And goodness knows we need it. With regard to, and this is very important for low middle income households, for renters, folks that rent their homes. So I think, this is very, very important, going forward. On the climate, you're absolutely right. This is, to me, the single most significant aspect of the legislation. And we've done a fair amount of work here trying to understand what the impact will be on CO2 emissions and then ultimately on the economy. And on CO2 emissions, we do rely heavily on the REPEAT program, which is a group of folks that thinking about this very carefully. And I'll just give you a sense of the magnitudes. So, and I'm rounding, so this is roughly right. Right now, the U.S. produces about 4.6 billion metric tons of CO2 emission. If we do nothing, no further policy action, we just let market forces work and technology to improve, our estimate is by the year 2100, that'll be down to 3 billion metric tons, which is still a lot of CO2, which is still going to create complete havoc with our environment and tremendous economic loss. Because of the Inflation Reduction Act and the provisions in that, and let's just assume that that's the end of the story, no other further climate provisions, policies implemented, by 2100, those CO2 emissions will be down to 2.4 billion metric tons. That's meaningful. And that does have economic consequence. So we ran that through our models where we link emissions to acute chronic physical risk, economic loss, what it means for insurance, government, and the economy at wide. And by 2100, it lifts GDP by 2.7%. That is consequential. That is meaningful. Now, this is way out into the future, I know, and there's a lot of it, but this is climate risk, and this is the kind of analysis we need to do because the effects of these changes that we do today have enormous effects, benefits, long run, and we have to think about the long run here when it comes to climate risk.
That's just really a fantastic explanation. Thank you so much, Mark. Kim, I'm coming over to you on this question of lessons learned and how we apply this as policymakers in the future. I heard Dr. Binder recently joke that as a member of Team Transitory that he was burning the team uniforms. There were so many things that occurred that were really difficult to predict. The protracted length of the pandemic and all the supply challenges that we had. But there were some trends that were clear for some time, and I wonder how you're thinking about the lessons and what it ought to mean for us as we go forward.
I mean, one thing that is quite clear is this is an extremely unusual macroeconomic situation. It's the pandemic itself is a very unusual occurrence. Having such a long pandemic that had such worldwide impact on the economy is very unusual. The Russian invasion of Ukraine certainly wasn't expected a couple of years ago. All of these have had substantial impacts, and they created substantial dangers, right? If you had under-responded in terms of stimulus to the economy that was happening in 2020, right? If you had just been like, well, the pandemic will go away, we don't really need to do anything, right? We could have easily ended up with unemployment in the double digits, right? And in fact, when the president took office, the CBO was forecasting that unemployment in 2021 would be 9%. Right. So there are big dangers to underreaction, and there are some dangers to overreaction. But I think one thing that policymakers could learn for the future is to focus more on instruments that automatically adjust so that you don't have to wait for Congress to act. So, for instance, you could have different types of funding that dialed up and down based on the macroeconomy, unemployment provisions that were also automatic. And then that would sort of not only put the gas on quickly when you needed it, but also take some of the gas off when you didn't need it, without relying on the judgments of Congress, which might be learning the lessons from the previous crisis rather than the crisis that they're in. A second thing that I think would be really important for preparing for whatever comes our way in the future is to just make sure that the tax system is shored up. And these investments in the IRS and this legislation are a really huge step in the right direction. And the tax on corporations is also helpful. But there's a lot of other things that we could do to raise adequate revenue that would give us more fiscal space the next time a crisis comes about, to be expansionary without worrying about driving up deficits and debt. And so I think there's a lot of low-hanging fruit that Congress could look to in the future to sort of shore up the tax system, but that includes working with other countries on tackling tax competition pressures through international tax. It includes closing loopholes like the SICA-NIT loophole that many pass-through businesses take advantage of. And so there's a lot of revenue left out there that we could use to sort of shore up, the ability of the government to respond to whatever comes our way in the years ahead.
That's fantastic. So I have a quick round of audience questions for each of you. Starting with you, Kim. I want to make sure that I'm getting this name right. So this question is for you, Kim. It's from Tamara Fusil. The question is, in a letter to Senator Graham yesterday, the CBO said that the inflationary impact of the Inflation Reduction Act in 2022 and 2023 would be negligible. Do you think this tells the whole story? How would you respond to this assertion? I'm going to give Dr. Blinder and Dr. Zandi their questions as well and come back to you. The question for Dr. Blinder is from Jarrett Farmer. The question is, can you please talk about why the Fed economists in general see full employment as a net negative? Most laypersons would assume greater employment for greater citizens is a good thing, with fewer unemployed neighbors, more citizens paying income taxes to local municipalities. Please help us to understand. And the question for Mark is a political one from Mark Liveright. Question is, could you give an honest counter argument as to why it might be better to wait until the Republicans pass their own Build America Better Act early next year? So first, over to you, Kim, on the CBO score and note.
Yeah, so one of the things to notice about this legislation is it is incredibly brave to try to reduce the deficit. And I think we should applaud Congress for doing that. That said, I think the CBO and others are right in noting that the macroeconomic size of that deficit reduction relative to an economy that's more than 20 trillion in GDP, it's not going to be an enormous mover, right? We're still going to be relying on the Fed. We're still going to be looking at other tools. So I think the legislation, while it's certainly moving in the right direction on inflation, the real reason that the legislation should be supported is because of all these other wonderful things that it does. And I think it is laudatory. I think we should take a moment and applaud Congress for fully paying for something, right? That's not an easy thing to do. And so maybe if they do it this time and they actually realize that the voters approve of certain types of tax increases, like maybe that will help them in the future when they're trying to tackle other fiscal needs that the government has. And then one more little footnote on this, which is that, of course, inflation is felt differently by different people. And so for some people, this will really move the needle, even if it doesn't have a huge macroeconomic impact. It could still have a very important impacts for particular families on particular goods that they're consuming.
Great. So, Dr. Blinder, we certainly don't have time for a seminar on full employment, but could you give us your best response there?
Yes, very quickly.
Yeah.
I would take serious issue with the premise of the question. I wouldn't have if that question came 20 years ago. But today's Fed has a very different attitude towards full employment than many previous Feds, including the one that I served on in the 90s had. And in particular, when the Fed revised its overarching framework in August of 2020, it explicitly said, I'm paraphrasing, they don't use such frank language, but it basically said, we're not so concerned with employment being high. We're much more concerned with employment being low. That was a big departure from many attitudes on the Fed before that. And that's the way they stand right now. And you could see evidence from that. That's one of the reasons, actually, ironically, behind the Fed's mistake, so to speak, getting off the mark too slowly. They were worried about employment, about the continuation of high levels of job growth. So they don't think it's a bad thing to have full employment.
Great, fantastic. So going to you, Mark, on this political question, and then Dr. Blinder, if you don't mind, I'm actually going to allow you to close us out, to give us your final sermon on why it's important for this bill to be passed now.
Well, I think, Patrick, I'm going to give plenty of time for Alan to give his sermon because I'm an economist. I only swing at questions that are related to the economy. So I'm not really even sure I understood the question. So I'm going to put my bat down.
I think the question basically comes to why is it that it's important to motivate this now as opposed to waiting for an opportunity to get some alignment with the direction Republicans may possibly be going next year.
Well, I mean, we can see how the political process works. I mean, it's very difficult to get legislation across the finish line. I mean, it's a miracle that they're getting this piece of hopefully. And even now, we don't know for sure if that's going to happen. I mean, getting it across the finish line is arduous, painful, and I think the beauty about my sort of view of the American political policy process is we're all working feverishly on all kinds of things. Nothing's getting across the finish line. And then all of a sudden, some window opens somewhere. When that window opens, we got to run through it and take advantage of that and get that piece of legislation passed. So we got to take advantage of this. If we don't, who knows, so I wouldn't wait for anything. We got to go. And by the way, this is good legislation. I mean, why wouldn't you sign on the dotted line? I can't figure that out. I mean, we're helping the climate, we're helping the seniors, we're helping low-income households on ACA, and we're doing it with, yes, we're doing it with tax increases on the wealthy and on large corporations that are making a lot of money. And it just doesn't, it feels like this is, and we're more than paying for it. We're actually going to bring down the budget deficit. So it feels like we should go walk through that window.
Spoken like an economist who actually understands politics, I'd vote for you to be king for a day. So I'm going to thank you, Mark. Thank you, Kim. You were both, of course, exceptional and really brilliant, but grounded in this conversation. And I come to Dr. Blinder with appreciation, deep gratitude, and a request that you send us out with a charge.
Well, thank you for doing this event. I want to send you out for a charge. Put this in political perspective. It was a near certainty that nothing like this was going to pass. All of a sudden, Chuck Schumer, and I take my hat off, if I was wearing a hat, take my hat off to him, pull the rabbit out of the hat. And so that's A. B, it's a very good rabbit. It makes serious steps on most of the biggest problems facing America. Climate change, inequality, that's largely through the tax side, and the cost of healthcare through prescription drugs. A personal note, I was in the Clinton administration in 1993, arguing for this in 1993. And the politicos said, forget about it, we're never going to do that, impossible. It looks like we may actually do it. And finally, the long-run budget. Kim made I think it was Kim or Mark, I think it was Kim made a very important point. Unlike almost every big bill you could think of that had gimmicks and this starts and then this ends and it sunsets, etc., in this case, the deficit reduction will go on beyond the spending. So while it's relatively modest in the first, it was Mark, in the first 10 years, I think you said $1 trillion in the second 10 years. That is completely ahistorical. Congress never does that. And now Congress has a chance to pass a bill that would do it. They should do it.
Awesome. Thank you so very much for helping us to land this very good rabbit. Appreciate all of you. And let's go get this bill passed. Thank you.